PM Modi's Independence Day GST bonanza is getting a big thumbs up from market voices as well. Hiren Ved sees staples and quick commerce gaining with defense and semiconductors as long-term winners. Bernstein's Venugopal flags only a marginal fiscal impact while staying bullish on retail and QSR. And Manish Dangi says that GST cuts will fire up festive demand even as bonds look set for a strong rally. Listen in.
While staples will benefit, but I think a leveraged play on staples is actually to buy the quick commerce and the large big box retailers. I think they should benefit significantly from the volume growth that will ensue as a result of the tax cut. So I think the entire basket should do well. In my view, I think defense is a 10-year story in India. It's a decade plus story. It is very strategic. There will be significant investments in the entire semiconductor ecosystem.
Your fiscal deficit perhaps is a 10 basis point sort of an impact. It could have been much higher if you don't really truncate capex. So that's the broad number. I would probably say it's more or less manageable in the overall scheme of things for this year. I would say defense capex will be a bit more rigid in terms of spending given the geopolitical requirements this year. But outside of that, most of government capex could essentially see some sluggishness. Some spending towards the discretionary areas, especially retail or QSRs, which I've been selectively positive through the year because of other factors as well. Autos, not very clear as to what happens to the rates out there.
Should see a spurt in demand, and particularly it's sort of well timed because it's during the festive season. It should help actually the consumption. In India, what's missing right now in substantial manner is the leverage cycle. The corporate leverage cycle, despite very, very high margins, hasn't really cranked up in a meaningful fashion. And so the GST cut, Fed rate cut, all of this should pave way for bonds to rally meaningfully more from where we are right now.